policy, and the fund offered them $150,000 for their policy, and they thought, wow, that would be great. The cash surrender value was zero, so it was significantly more than they would have gotten if they cashed their policy in. He called us and we said, well, that's a decent offer. Let us see if we can do better in our auction process. And if not, you can take the $150,000 offer with the TV company. So we went through our auction process and we were able to get the client a few weeks later $235,000 for the same $1 million policy just by adding that competitive process.
Awesome. 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 I love that kind of stuff. I just love it. And the problem is that people over the age of 70 or even over the age of 50, even young in their teens, they don't know what they don't know. And so that, to me, it just seems, well, why would you want to just take one bid? Why don't you get multiple bids? And that seems to me to be the better way to go. So I appreciate your explaining that, because I think people get taken advantage of too much and too easily.
Absolutely. And, there are billions of dollars of life insurance policies that are surrendered, that are owned by seniors. So that's really why we have a passion about education in this market. And we go around giving seminars mostly to advisors. So to the financial advisors, to the attorneys, to the CPAs, to make sure they know that their clients are aware of this option before they terminate their policies, so that there's not hundreds of millions of dollars around the U.S. left on the table that should be in seniors' pockets.
I think that's great. And it's good to get the word out to the professionals, because they can then in turn give good advice. It sounds like there might be many of these types of arrangements available that people, because they saw the ad, they would know about, but there's too many of the shysters out there, and it's not a good thing to be involved with. So how much does it cost for them to process the application through you?
Yes, so there's absolutely no cost to the client or the consumer to process the application. We incur 100% of the cost of the application, of the auction process, of the medical records process, etc. And we provide the client with a final offer once the auction is completed, and they can either accept it or they can walk away and say it wasn't the amount they wanted, and that's okay too.
Interesting. Okay, so what if somebody has a policy, like a term insurance policy, and they submit it? What is in that policy that would make you not able to sell it in an auction environment or any kind of an environment to sell it? What is there wording in there that makes it not usable or sellable?
Yeah, so there's a few things. Assuming they are over 70 and in moderate health, the biggest contractual provision within a term insurance policy to make it sellable is called the conversion provision. So in every term policy, there's a contract that spells out all the provisions in the contract, and most of them have conversion provisions. The nuanced language states when that conversion provision ends. Some of them end at age 65, some of them end at age 70, and some of them go for the life of the term. Now, a conversion provision essentially says you as the owner can exchange the term insurance policy for a permanent form of life insurance with that company with no underwriting for your health. So with that exchange, that creates a lot of value to the buyer. They do not want to buy a term insurance policy that's coming to an end and has 1 year left on it. What they are interested in is a term policy that you no longer want or is coming to the end of the term, but they can exchange it for permanent insurance and pay those higher premiums that you don't want to pay.
Interesting. Okay. Well, I'm learning an awful lot here, but do they have to pay taxes on the proceeds?
Also, great question. So let's talk a little bit about taxes. But before I say anything regarding taxes, while I'm fairly adept at the taxation of these transactions since we work on them daily. I'm not a CPA or a tax advisor, so I would advise all listeners and all consumers to speak with their tax advisors before completing a life settlement transaction.
Of course, that's good advice. Excellent.
The first tax ruling on life settlements came in 2009. To me, it was a big deal because there had been very little guidance from the government and the IRS in particular on how these transactions should be taxed or governed. Once the service made a ruling in 2009, while it was a little bit confusing, it was still good that they're paying attention to this marketplace. In my opinion, it's more regulation, which is a good thing for the consumer, and it takes a lot of the guesswork out for the tax advisors. In 2017, as part of the Tax Cuts and Jobs Act, they provided further guidance and clarification, which both made things a whole lot clearer, but also benefited the consumer or the seller, which of course we advocated for. The typical transaction, again, make sure you contact and consult with your tax advisor. The typical transaction would be an old universal life policy, and the client has paid in a lot of premiums over time. The premiums that you paid in are considered basis for tax purposes. What basis means is that's considered your original investment, and you should get up to that amount back tax-free. Anything above that is taxed as long-term capital gain. So it kind of clarifies this life insurance policy as an investment. You bought it for X amount, paid into the investment X over time. That amount is principal, and you should get that back tax-free. And any gain that you get over your premiums paid is long-term capital gain, since it's a long-term holding.
Interesting. Okay, well, let me ask this. I just thought of it, and we are getting close to the end of the segment, but can somebody sell just a portion of a policy, or do they have to sell the whole thing? How does that work? Does they have the whole thing goes?
Yeah, so you can sell a portion of the policy, and there's a couple of ways to do that. And once again, it depends on the contract and what your goals and objectives are in selling your policy. We've done it a couple of times. There's two ways to get money from a life settlement transaction. The first is the traditional way that, if you've heard of this type of transaction and strategy, you probably have heard of, which is getting a pile of cash. You get a check for $150,000 for your policy. The second, which is a little bit more interesting, is called a retained death benefit offer for your policy. In lieu of cash up front, you are made the irrevocable beneficiary for a portion of the death benefit. So I'll give a quick example on both of those if we have time to do so.
Yeah, let's do that. We are getting close to the end of the segment, but I think people would like to hear specific strategies. So keep talking. This sounds good. Great.
So a typical cash offer, I'll talk about a client we worked with recently. He's 74 years old and had a $3 million term policy that was coming to an end in just a few months. And it was going to expire with no value, as term insurance policies do. He didn't need the coverage anymore and had no interest in paying, significantly higher premiums to convert the policy to permanent insurance. The key, though, is that it was still convertible. It had that conversion provision still active in the contract. We were able to get that client $150,000 in cash for his expiring term policy.
Wow.
He thought it was worth nothing, as did most people. So he was absolutely tickled to say, wow, I just found $150,000 that I didn't know existed.
Wow.
The next client I want to talk about, because I do want to give an example of selling part of the policy or a strategy that's like that. It was a couple in their mid-80s. and the wife had already passed away, but it was what's called a second to die universal life policy. Those were typically purchased for inheritance planning or estate tax planning. He had the beneficiaries as his children, but instead of paying premiums, he was more concerned about his own lifestyle, his own retirement, his own long-term care and longevity planning. So he had stopped paying premiums, and the cash value was getting close to going to zero, at which time the policy would have lapsed. We got introduced to him through one of his advisors, and he decided he didn't need the cash up front. He was doing pretty well financially, and he didn't want the cash up front. So what we did was we structured it as a retained death benefit settlement. And he was able to get, it was a $2 million policy, and he was listed as a beneficiary, or his children were listed as a beneficiary for $850,000 of the policy, and he has no premium obligations moving forward.
Wow, that's just wow. That's awesome. I know we would love to listen to more, but unfortunately we're running out of time. And I want to thank Matthew Friedson for joining me today. But Matt, if somebody really needs to talk to you further about their policy, how can they get in touch with you through email or however you want them to contact you? Please leave that information, because this is all important.
Thank you so much for having me on today, Debbie. I really appreciate speaking with you and your listeners. I'm happy to answer any specific questions that any listeners may have. My email is mfriedson, MFRIEDSON @GWELLC.com. And my direct phone number is 240-644-6737.
Awesome. Thank you so much for joining me today, Matt. I have learned a lot about this topic, and I'm glad we had you on to help us uncover what's real and what's not real, and what's reasonable and what's not reasonable. So thank you so much.
Thank you, Debbie.